In this week's video, we'll cover Italy, the U.S. economy, and the charts for the week ahead, along with a review of May performance. With Italy dominating the news in the markets this week, this quote by Alexander Tytler sums up the cause of most sovereign debt crises. Maybe some of the particulars about forms of government have changed, but the behavior of people hasn't. Once people discover that they can vote themselves a share of the public purse, spending exceeds revenues until debt becomes unmanageable and ends in economic crisis. The world is awash in sovereign debt, and this week we watch the EU and the markets grapple with Italy's debt and initial fear of default. Let's use a household to understand Italy's problem. The household is spending more than it earns. One spouse sees the budget and wants to reduce spending, and the other wants to keep spending and says no. Their credit is healthy and they decide to open more credit cards. Their debt grows, they try to work more, but when it comes to reducing spending, they still decide no. As they continue to spend, they max out their credit cards and their debt grows. They decide to open more credit cards and they still don't reduce spending. Now they're becoming perceived as a credit risk. They start juggling payments and making some payments late, and as they do, their interest rates go up. But there's still more room on the credit cards and they continue spending as their problems continue to grow. The situation becomes dire as they fall further and further behind on payments and are denied credit. Now they're forced to stop spending, but it's too late. They've accumulated more debt than they can possibly repay, and they lose everything in bankruptcy. As we saw in the opening quote, governments have voters who don't want to reduce spending. Rather than reduce spending, the government can decide to access credit by issuing bonds, which you can think of as an IOU with interest. Another tool for a government to use is to print money or devalue its currency, which makes the currency worth less over time. When a government's debts are denominated in its currency and it reduces the value of its currency, creditors that own the debt get paid back less. At this point, the debt is so large that it would be impossible to pay it off with tax increases, and voters still don't want to cut spending. Creditors see the growing risk and demand higher rates. Eventually, the debt rises to unsustainable levels, and the government no longer has access to credit at reasonable rates. Just like what we all understand happens with a household, the government is forced to admit to creditors that it can't pay its debts, and it defaults, resulting in economic collapse. The fear with Italy this week was not default, but they would withdraw from the EU and return to the lira, which would allow them to use a weaker currency and devalue some of their debts. So what are Italy and so many other governments spending so much money on? Unsustainable spending on social services is the main contributor to Italy's debt problems. In this chart, you can see social spending for several countries, including Greece and Italy among the top 5. Germany is a nation of savers with a debt-to-GDP ratio that is close to the world average. Germany well remembers the hyperinflation of the Deutschmark after accumulating unpayable debt from World War I. Sweden has one of the highest tax rates in the world to pay for its large welfare state. We've seen this movie before, and we've heard the terms Brexit and Grexit and Italexit. So let's look at these and find similarities and differences. Brexit turned out to be a good buying opportunity in the market. It was a referendum on membership in the European Union, and Britain didn't use the euro. Grexit offered the prospect of currency devaluation, withdrawal from the European Union, and eventually ended up in default on Greek debt. Defaults have significant impact on the markets. The prospect of Italexit earlier this week stemmed from the appointment of an economic minister who advocated withdrawal from the European Union and from the common currency, which would have resulted in a devaluation of debt. This is more similar to Brexit than Grexit. While Italy's debt problems are far from resolved, politicians have learned some lessons from Grexit. There's a lower risk of contagion, and much of Italy's sovereign debt is held domestically and by European banks. In terms of positives for the markets, the probability of rate increases by the Federal Reserve dropped. The prospects for the December meeting dropped from 43% all the way down to 22%. There were additional positives to be noted on the yield curve, which we discussed last week as a predictor of recession. Note that the yield curve right now is not inverted. The yield on the 10-year note, which has been rising, is shown in the middle panel. The yield dropped this week, giving the market a much-needed breather amidst risk-off news. The 3-month yield is shown in the lower panel. I'm sure we haven't heard the last about Italy, trade wars, or North Korea, and even if we did, there would be a new area of concern to take its place. As always, if the market becomes concerned enough about any issue or crisis, we'll see it in the charts. So let's turn from Italy now to our overview of the markets. Despite all the gyrations and headlines in the market, the stock market values future earnings growth. The U.S. economic story is intact, and Friday's job numbers were historic. Supply-side economic policies continue to drive the recovery, driving record earnings growth, business spending, consumer spending, and inflation remains relatively tame. The bond market and the credit markets usually sniff out danger before the stock market. As part of our model, we look at several measures of the bond and credit markets. One measure is the preference of investors for high-yield, higher-risk corporate bonds versus risk-free treasury bonds. We are seeing signs of caution, likely related to all of the headline threats bombarding the market. As we look across indicators such as RSI at the top, which is a momentum indicator, we see that RSI dropped out of overbought and made a lower high, but is still holding above the center line. Williams %R has a similar story where we've dropped below the overbought line and made a small lower high. These are simply signs of caution that deserve our attention. This is why we use a model that incorporates 400 metrics similar to these to determine the overall health of the market. Overall, our model score remains bullish. Now we'll switch to looking at the week in review, but before we do, we're quickly showing this chart to highlight periods of sideways, range-bound trading in the gold boxes and false breakdowns below the boxes, which are often a bullish signal of selling exhaustion. Note that these are the points at which everyone who wanted to sell is out and the uptrend resumes. As you'll see in the next chart, we say that patterns in the market are fractal. The same patterns that occur on longer time frames occur on smaller time frames. With earnings largely over and tightening liquidity, we are trading on headlines. This chart is a 20-day, 1-hour chart to show you that we've been trading in a range bounded by the gold box. The news out of Italy caused a breakdown below the box. Oftentimes, this becomes a false breakdown and the market will trend higher. Friday's jobs report propelled us higher, and as of 2 p.m. on Friday, we're slowing as we approach the top of the box. We'll learn more about whether we can continue and break out of the box next week. This type of chart is a candlestick chart, which we use frequently. If you're unfamiliar with candlesticks, visit our YouTube channel. We provide a simple overview in our video titled S&P Long-Term Patterns and Fractals. Zooming in on a 1-hour chart of the S&P for this week, we had a shortened week with the Memorial Day holiday. Headlines on Italy began breaking over the weekend and through the holiday about the new coalition government's proposed economic minister who advocated withdrawal from the EU and from the common currency. These events continued to impact the market on Tuesday. Later in the day on Tuesday, we received news that the Five Star and League parties had withdrawn their candidate for economic minister, and we saw buying on the bell. We had follow-through on Wednesday, and risks continued to recede, only to have Trump announce steel and aluminum tariffs on the EU, Canada, and Mexico on Thursday. On Friday, we had a historic jobs report which propelled the market higher, but not out of the range. Throughout this week, you see the importance of the February close. On the daily chart, you can see the symmetrical triangle pattern from the correction that we broke out of. This week, the headlines about Italy caused us to go back and retest the upper side of the triangle, which was successful. And as we noted on the 1-hour chart, this may have also been a false breakdown below the trading range that cleared out most of the sellers and allows us to move higher. We had dropped below the February close, which was on the lower part of the trading range, and recovered that as well. And we've changed the color of the 61.8% Fibonacci retracement to green to denote support. This level was labeled as resistance in red previously, and oftentimes when resistance is broken, it becomes support. Finally, we note the next zone of overhead resistance begins around 274. To identify areas of resistance, you can look across the chart and see where price has opened, closed, and touched this area multiple times. Recently, price has not been able to clear this level. Looking at our chart for the week ahead using inverted triangles, you can see where price currently is between the descending green line and the ascending red line. The boundaries of those two lines form an inverted triangle, which you see here. The red line serves as potential resistance to price advance, and the green line serves as potential support. When you're trying to gauge where price might go, you need to ask where it has come from. Price has been trading in a sideways range, which in this context can be thought of as resting after a move up from the last test of the 200-day moving average shown in green here. Usually consolidation like this is building a base of strength before moving higher. As always, that could change, but the current probabilities point higher. We'll look to see if price can break out of the trading range that we've shown on the 1-hour chart and above the red line in the coming week. Anytime we close a month, we like to inspect our monthly charts closely. Our model asks questions of the market on a yearly, monthly, weekly, and daily time frame. The monthly charts are conclusively interpreted at the close of the month, so let's see what we can learn. This monthly chart of the S&P goes back to 2003. The chart shows the 6, 9, and 12-month moving averages in blue, red, and green, as shown in the legend in the upper left-hand side of the chart. We're currently in a strong uptrend with price, as shown by the candlesticks, above the moving averages, and all of the moving averages pointing up. Looking at 2008, you can see that when price drops below the moving averages, and the moving averages cross over and turn down, we enter a bearish trend and significant losses follow. Looking at the upper right-hand side of the chart for how we closed in May, we closed above the February close, which was very important for the continuity of direction and price across time periods on daily, weekly, and monthly charts. The direction across all time frames is up. We can see that price is above the moving averages, that all the moving averages still have a positive slope, and we have good space between them versus moving averages that are contracting or moving down. While we've officially entered the seasonally weaker summer months, the uptrend is still intact. This could change at any time, but we deal in observable evidence that we can see on the charts today. With May in the books, let's look at monthly performance for the sector ETFs. You can see that semiconductors, technology, and small caps top the list. IWM continues to offer shelter from a stronger dollar and trade concerns. And as we go down the list, you can see that the greater the international or dollar exposure, the worse the performance. XLE or energy took a hit from talk that Saudi Arabia and Russia might put additional barrels on the market, but still delivered solid performance. The inflation trade slowed somewhat as well. Rounding out the bottom, large cap financials were hurt by the fall in rates and the knee-jerk selling related to Italy. Utilities and consumer staples, which are defensive dividend payers, continue to underperform. This shows continued appetite for risk, as does weakness in the VIX, which is Wall Street's fear gauge. All told, the charts and performance as measured by our model still point to continuation of the uptrend. As we close, perhaps Charles Dickens gave the best advice on managing financial affairs with his admonishment to live within our means, save, and although unspoken, to invest just as prudently. Next week, we'll bring more headlines, good and bad, for the market to digest. We'll stand back and take a longer-term view, ready to measure the pulse of the market with our model and invest accordingly.
The information in this video cannot address the specific investment objectives, financial situation, or particular needs of any viewer. The information presented is solely for informational purposes and is not a solicitation or offer to buy or sell any security or financial instrument. None of the information in this video should be taken as investment advice. Any opinions expressed in this video are subject to change without notice. Caliber Capital Management, LLC, or KCM, is not under any obligation to update or keep the information contained in this video current. KCM, its officers, employees, or clients may have an interest in the securities, related securities, or derivatives of the securities referred to in this video. KCM accepts no liability whatsoever from any loss or damage of any kind arising out of the use of all or any part of this material. KCM recommends that you consult with a licensed and qualified professional before undertaking any investment decision.